Good afternoon, everybody. Welcome to our new webinar series. If I don't get to see any of you in the teleconference over the next couple of weeks, I certainly hope that you have a good festive break and that you'll be refreshed for 2015. So, this is the first time that we're trying out our new webinar software. So if there's any technical hiccups, obviously please bear with us, but I think so far it's been quite smooth. So what I want to give you today is an update on a couple of the key issues happening in China. Also, for those of you that attended our roadshows in August, to give you an update on how our strategies have played out. For those of you that have been looking closely at our returns, you should be quite pleased at what we've achieved, and we've promised exactly what we said we would do. Just want to give you an update on the strategy and the key themes that's driving the performance. So obviously, as usual, our disclaimer, this is not specific product advice, and this is just general advice as we move through the presentation today. This presentation will actually be uploaded straight after or within the next 24 hours. So if you wanted to send this to your colleagues as well, by all means, send this and forward this to them. So with our agenda today, what we're looking at is 4 kind of key themes that we want to talk about. Just a bit of housekeeping as well. Besides the webinar being recorded, there's a question box that you should be able to see in your webinar kind of toolkit, and during the course of the presentation, please feel free to ask any questions, and I will try to answer them in a timely manner at the end of my talk. As well as that, there will be 3 quick questions straight after the webinar, asking you to fill in for us, and they're really quick questions. So if you could do that, that will be of great help as well. So to start off, let's have a look at where the market sits today in terms of opportunity. So we're getting a lot of views in terms of the market, in terms of where people are asset allocating for their clients going forward. We've always had a really great one with Australian equities. Developed market equities, especially in the US, has done extremely well. So people are trying to find pockets now of those markets in terms of where we're going to allocate for our clients. But Korea and China being our kind of 2 largest allocations for both our Asia fund and our for our Asia fund, and obviously China being our largest allocation to our China fund, it still presents the best value, and I would still say that it is a free kick. For those of you that follow Jonathan Payne, last November he quoted the last plenum meeting and said that this is a watershed moment for China in terms of the market turning around, and since then the markets have done extraordinarily well, which I'll talk about in a minute, and it is only a kind of a stage 1 as part of what we like to call a 3-pronged strategy, especially for the China fund. In terms of where the government is taking the economy, one of the key points that they're trying to do is targeted stimulus. So post the 2008 and 2009 period where they came out and went with mass stimulus, whereby they overinflated certain sectors of the economy, including infrastructure and property, and then subsequently had to come into control the outbreak, especially in terms of property prices. They are now turning their focus, and remember, this is a new government that started last March, and they're really being targeted in terms of their stimulus, measures. This has obviously all happened up until 2 weeks ago, when the Chinese government actually cut rates for the first time, which is obviously broad-based stimulus, and I'll talk about that a bit more detail in a minute as well. So in terms of the targeted stimulus, as you can see, the infrastructure investment side is obviously quite self-explanatory, but one of the key measures that I'd like to discuss in a bit more detail is actually the prudent monetary policy. So you can see in the middle of this chart, of this slide here, one of the things that they've used now is called pledged supplementary lending. So all these kind of 4 items I'm going to talk about are very, very specific and very, very targeted. In terms of what pledged supplementary lending is effectively a way to allow the banks, which have been stuck on a fixed loan-to-deposit ratio of 75%, to now be able to use their actual balance sheet assets as collateral to be able to then give it to the PBOC, which is the central bank, in return for more funds to lend out to the market. Now, you have to remember that over the course of the 2008 and 2009 period, the people that missed out most in terms of the credit and the liquidity into the system were small to medium enterprises in the agricultural sector, which is where the government now is pointing their stimulus towards. So the way to explain why that occurred is quite simple. If I use an example of a large multinational company, let's say Apple, versus, let's say, XYZ financial planning firm in Mossman in Sydney. Okay, both of these companies want to get funding to expand their businesses, but the bank has got a limited amount of credit facility, but at the same time they have to lend it at a fixed rate, let's say 7%. If you are a bank and you have the opportunity to lend the same amount of money, $1 million to either Apple or a financial planning firm in Mossman, and you're still going to get a 7% risk-reward trade-off, who would you lend it to? Of course, you're going to lend it to the large multinational, which means that the small and medium enterprises have been left out as the liquidity on credit has dried up. So with the pledged supplementary lending, the whole target point is that that new funding has to go into small, medium enterprise and the agricultural sector. The targeted reserve ratio requirement, which is the second point there, the RRR cut, has also been enforced now, whereby the RRR requirement for large banks are about 20%, but the rural banks are about 13%, meaning that the bank can leverage its balance sheet further to be able to lend more money out into the market. There is also now an adjustment to the calculation of loan-deposit ratio. As I said, there was a 75% fixed rate before, but now if the bank decides to lend more money again to small, medium enterprise as well as the agricultural sector, that money is now not included as part of the loan-to-deposit ratio. And the fourth point is the injections through the standard lending facility. So that's just standard credit moving into the system. In terms of the property market, obviously it is still a very, very key and important point to the economy. So the government obviously has a very, very difficult balancing task in terms of not overinflating the property market, but at the same time not killing it, because it's still going to remain a large portion of the economic growth going forward in China. And it's still going to be a key point to sustainable growth and also an upgrade to the standard of living for people in China. But one of the things that they've realized is in the last 12 months, we've had a correction of property prices of 4 to 6% depending on the city that you're in, which is a good thing, but they want to kind of re-stimulate to create sustainable price growth. So one of the things that they're doing is, in terms of first home buyers, you can leverage up to 70% LVR on your first property. And the second property, you can lend up to 30 to 40% into LVR. The third home, you can't. What they've now changed and slightly tweaked was that if your first home has been completely 100% paid off, you can now actually lend your second home, or sorry, your second property at 60 to 70%, and then so on and so forth. So it allows more people to enter the property market, and is still focusing on getting more first home buyers into the marketplace. Now, rate cuts. This is a very interesting situation that we're facing. So, as I said before, the government has always mandated and fixed the rate at which the banks are allowed to receive deposits in as well as lend money out. But over the course of the next 2 years, we actually expect liberalization of interest rates and actually allowing competition. The interesting thing from our portfolio perspective is that we believe that there's going to be quite a number of challenges that will face the banking sector, because if you've been in a system whereby you've never had to fight to obtain or keep your customer because the rates are effectively the same across the board, then now you're introducing competition and the banks may not exactly know what to do. The banks make up a big part of the index, which is fine, and we believe that in an absolute sense they will still perform, given the strong outlook for the Chinese share market. But we believe that on a relative sense they will underperform, so we are tilting our portfolio, and we've actually tilted, and in the China fund we hold no banks, and in the Asia fund we hold a very, very small allocation to banks, which is actually one Taiwan, the Bank of China, and one in DGB Financial Group, which is in Korea. So outside of the Bank of China, which actually stems a lot of their revenue actually outside of traditional banking, which is why we're happy to continue to hold them, there's no other bank in China that we're happy to hold. As you can see on the bottom right-hand portion of this graph, you can see that where with this new interest rate liberalization program, this is where the banks are actually going to start to they're not going to have an issue in terms of survival, but they're obviously going to have pressure on their NIMs or net interest margins. So what before they had in 2007 was about 350 point spread is now dropped to about 230. Now, as well as this, what we actually like about this rate cut situation is it does provide a signal to the market in terms of the government will protect growth. The government, we believe, will manage to churn out a 7.3% growth this year, but expect it to continue to slow, and we expect growth to be between 7 and 7.1% for the 2015 calendar year. So, but at the same time, from a portfolio perspective, what we actually like is 3 sectors that we believe will benefit out of interest rate cut, which will be the property market, the broker market, and the insurance market. The insurance market will benefit because it will force more money into the economy, and more people will be looking for higher returns. Insurance companies obviously have most of their investments in listed equities or infrastructure, so an insurance tilt for us is a beta play. The property market, we believe that it will strengthen on the back of a rate cut for obvious reasons, and brokers through a lot of these other new programs like the Shanghai Hong Kong Stock Connect, which I'll talk about in a minute, will also benefit. So we currently have 14% allocation to property, 10% allocation to insurance, and 2% in broking houses, which takes the total to 26%, which we believe is a healthy allocation to what we believe to be a future good performance for the China Fund. We also expect to see a further reserve ratio cut sometime in the next 12 months to also continue to feed that standard lending facility for the Chinese economy. To give you an update, for those of you that didn't come across our August roadshows, we talked about the different share classes and how this is now being a structural change, which is leading to quite strong performance in the short, medium, and long term, and it's played out in the short term exceptionally well for us. What I'm focusing on here, everyone, is on the A share market and the H share market. In a very, very short way of explaining, when we launched the fund in 2005, the A shares were trading at a 30 to 40% premium against the H share. Today, it's turned around because the A share market has been in a perpetual bear market for 4 years, and the H shares on general are trading at about a 17 to 18% discount, 17 to 18% premium to their A share counterparts. And as the market is further opening with the launch of the Shanghai Hong Kong Stock Connect program, which is something that we are banking a lot of our performance on, it opens up the market and allows for the first time an open way for people to transfer money from Hong Kong into the mainland of China to buy listed equities, and then also the other way around. What's interesting to note, though, is that there is a $13 billion quota going northbound every day and a 10 billion RMB quota going southbound. What's interesting to know about that currently is that in the first week since it started, which was in November, we have seen that it's only been used up 2.5 billion RMB northbound every day and about 300 million southbound. So obviously, there's been a lot of technical issues surrounding where the market is, and also the way of settling share buys and sells. And the simple reason for that is because you have a new settlement system in China which is called T-1. So as we all know, when we trade a share in Australia, it's T+3. You don't have to prove you have the stock or the cash on hand to pay up until 3 days later. In China, it's the reverse model. Before you place the trade, you have to prove that you either have cash on hand to buy the stock or that you have stock on hand to sell into the market. So a lot of brokers and custodians have had issues going around this issue. As we move forward, it's going to obviously improve, and more brokers and more custodians will be able to trade the system, and obviously the daily quota will be used up far quicker. One thing to note, everyone, is that the Chinese market is actually now the world's second largest capital market, and it's the second largest capital market, now overtaking Japan. So in terms of finding market depth, or finding a market that has depth for you to invest in, China is definitely now so huge that it is very, very hard to ignore. In regards to the Shanghai Hong Kong Stock Connect program and how that's played out, as you can see in the top right-hand chart there, is that since April this year, the market has started to rally. Now, everyone has to remember that the Chinese market is split into both A shares into two ways. Half the market is in Shanghai and half the market is in Shenzhen, which is depicted in the blue line as well as the red line. As you can see, this has rallied up very, very strongly. The other thing that you can see in the bottom chart here is that the turnover has also significantly increased and is at an all-time high, and people are very, very interested in the market. Now, the first part of what we did in terms of the strategy was to deal with the arbitrage. Because there are a lot of companies that are dual listed between the A market and the H market, we wanted to close down the arbitrage, just like if Rio Tinto was in an open market in Australia but a closed market in London, there would be a large price discrepancy. So over the course of the last couple of weeks, then the gap between the A and H shares have significantly closed in, and the best example of that would be the insurance sector, where even a week ago there was a 10% discrepancy, meaning the H share was 10% more expensive, and now the A shares are caught up and there's literally no arbitrage opportunity. But the healthcare, auto, utilities, and white goods sector still have some arbitrage which we're exposed to, which is, we believe, is going to be good for us going forward. So the one thing to note, though, this is stage one of a three-stage bull market for China. The second stage is actually Shenzhen, Hong Kong Stock Connect, because only the Shanghai part has been open. And over the course of the last couple of weeks, we've also been accumulating Shenzhen A shares to be able to take advantage of when that will open, which may be 12 months from now, but it's a strategy that we believe will play out. The smart money this year has gone into China. So smart investors have realized that most of the developed world outside of Europe, which obviously is still a basket case, is not cheap. So where are we going to allocate the money going forward and allocate it in a tactical way where we know there is a very, very low risk of downside? So China is the low risk of downside because, again, we have to separate what happens in the economy versus what's happening in the market. As you can see in this chart here, that the Hong Kong listed China ETFs have gained significant ground in terms of inflows. At the same time, the EM market's also got an inflow, but that's actually tapered off. What we haven't included in this chart, which is probably the most shocking part, is that over the same time period that there has been $8 billion in net outflow, US dollars, in terms of US S&P 500 ETFs. So money is now leaving the US and entering back into places like China and other emerging markets. So this is the time to be able to get into the world's cheapest market. To give you an update in terms of value partners, as you can see here, in terms of the risk-reward trade-off, just to give you an update to ending October, their 21 and a half years track record is still intact at 16.1% per annum, which is very, very strong. And then their annualized volatility is still sitting at 21%. In terms of looking at the Premium China Fund and giving an update on that, you can see that ending October, our China A-share allocation, as per our strategy, is at 13%. As at now, when we're talking, the China A-share allocation for us is now up to 18%. We hope by the end of the year to hit 20, and then by into about mid-next year, we'll get it all the way to 25. Which is a key discrepancy in terms of our portfolio strategy. As you can see, in the last 6 months ending October, we've actually done 16.8%. If we look at the figures ending November, which are currently being audited for compliance reasons, at the moment, our rudimentary figure sits at 6-month performance is 19.45%, and now annualized return since inception ending November is actually at 11% net of fees. What you can see here as well is that the strategy that we talked about last year with a lot of China B companies wanting to convert into Hong Kong paid off for us also in the last 12 months. And the B shares that we're holding on still there are also quite a number of them are primed for conversion as well. If we look at the sector split at the moment, as you can see, the banks that are sitting there at 2% at the end of October now no longer exist. We've sold out, obviously, of all of our banking stocks. In terms of our top 10, the only thing that really has changed is Tectonic Industries, which are currently selling out of. So they're the people that run or manufacture all the portable batteries for Ryobi and Dirt Devil. And then as well as that, most of these holdings are effectively into the consumer discretionary or IT side. Remember, our key themes for the last 12 months have been obviously the motor industry, which is still obviously one of our favorites, as well as food and bev, for those that have competitive advantage, the 4G deployment, as well as the property sector, which has been absolutely hammered, and which is why we still now have 10% of our allocation in the real estate. The other important thing to note is also our cash holding is almost zero, and we have a 100% deployed portfolio because this is just the cheapest market in the world, and we see a lot of opportunity that comes about that as well. One of the key holdings that we've started accumulating is actually Ping An. So the insurance sector and the broker sector is the non-bank financials that we like at the moment. And the reason for that is because they are now starting to sell products to the mum and dad consumer, which traditionally only banks used to do. So your wholesale products, wealth management, broad insurance services are now services that actually the insurance sector as well as the broker sector actually offer. So in the last week, we've actually bought 4% of our portfolio has gone into Ping An Insurance, 2% in A shares and 2% in H shares, which is why we're showing the metrics on the left-hand side there. The reason why I've bought both of them is because we believe both of them are just as attractive, so we're kind of hedging our bets from that perspective. The interesting thing to note as well is that Ping An's been underperforming its peers in the sector, and so we believe as a deep value manager, we think they're going to pay off quite well. Other interesting thing is that Alibaba, which is the world's largest IPO a couple of months ago, as well as Tencent, which is the people that own the WeChat or the Chinese version of WhatsApp, which was bought by Facebook for $19 billion, recently did a placement 2 weekends ago worth $30 billion that was shared by Alibaba and Tencent. Now, there's no specific reason why they've done that, but from the perspective of having smart investors enter a company, we found that transaction to be rather interesting. Those two companies are doing very well themselves, so hence why we actually see some very, very good potential out of Ping An. The other major theme that everyone's been fighting about, and we've gotten quite a strong allocation to, is CGN Power, which stands for China Nuclear Power Co. So if you remember from our August roadshows, we talked a lot about wanting to leverage our SOE allocations, and we believe quite strongly in SOEs being an outperformer as the government is reforming the economy to be more market-orientated as opposed to just being controlled by them, which obviously then in turn gives confidence to the population. With China General Nuclear Power, there are two nuclear providers in China. Both of them are SOEs, and this one is going for listing. After a very, very strong hard slog, because of Value Partners' sheer size and power, we've gotten our hold of a $100 million allocation to its IPO, and subsequently 3% of the China fund has also received allocation, which is about $6-7 million Aussie to buying this at IPO. As you can see on the top left here, the China energy production for nuclear was 1% in 2013, but now, in 2013, and by 2025, we're hoping that it will be about 5.3%. It's a cleaner way of energy. They made it very clear after Fukushima in Japan that the Chinese government said we're still going to go ahead with our nuclear power plans because it's just simply more effective and more scalable. So on top of the cleaner energies like wind and solar that we've been investing in for years for the China Fund portfolio, and those sectors have been receiving government subsidies, we're now very, very much into the nuclear story, and it's a long-term payoff for us. So for those of you that are also scared about SOEs, well, most investors, a lot of investors in Australia participated in the recent Medibank private float, and let's be honest, that is an SOE as well. So that is something to look out for in terms of our portfolio. In terms of our Asia fund, which many of you use as an alternative to the China fund because A, it's unhedged in terms of currency, but number two, it's also has exposure to other Asian countries, our allocations are still the highest to South Korea because it's been an underperforming market. It's a market that's undergoing a lot of reform, in which we like, and also increasing payout and dividend ratios in that market as well. So ending for the month of November, the fund continued to rally quite strongly of 2% net of fees, and we're happy to announce that our Premium Asia Fund has hit a 5-year anniversary where our annualized return since inception is now just shy of 11% at 10.83. If we benchmark ourselves against all the competitors in the market, as you can see here, we generally don't map against a particular time frame. Just since inception, you can see the performance of us, and also it's interesting to note which actually of the other funds in the marketplace actually are quite linked and quite index hugging. So it's a very, very, very strong strategy, not benchmark aware, which is why you can see we've got a quarter of the portfolio in South Korea. If you look through the list of our top 10s as well, you can see South Korea certainly features in quite a number of names. So if you look at our second largest holding, like Amore Pacific, they own things like Laneige. So Laneige is that skincare cosmetic product which many of you might know of. And then we've got things like Luye Pharma Group, which is one of the 6 only listed pharmaceutical companies in China, but this version is listed in Hong Kong, and they actually are now engaging the R&D portion of pharmaceuticals, which is good to see that, again, China is moving up that food chain in terms of being able to add value as opposed to just being a manufacturing type of economy. So in summary, we definitely agree that China's economy will continue to slow, and there'll be further pressures on it, but it will be more sustainable. And at 7.1% for next year, I think it's still a very, very strong figure to keep in mind, but it doesn't impact a lot in terms of the way that we're positioning our portfolio. The Shanghai Stock Connect program, as we announced in August, which has come through, has provided us with a very strong position for our portfolio and also for your investors. And after all the further technical issues, and one of the technical issues now sitting in the market is actually UCIT funds, and UCIT funds are all the European funds through the European passport, are struggling to find a way to get into the Chinese market because they're desperately wanting to get in, but haven't cleared their technical issues. So once that clears, I'm sure you'll be able to understand the flood of money that's going to go into China. Clean energy is obviously a big theme that I'm introducing now into the portfolio, and also some arbitrage with similar companies within the same sector between the A and H, and the valuations. Even with the recent rally, the Chinese market is still sitting at about 9.5 times against what was months ago was about 7 times. So it still remains to be the cheapest market in the world. The last thing I want to remind everyone of is our reasonable basis resources. Now, if you look at the screen now, I've just brought up on Chrome our website, which is just premiumchinafunds.com.au. Now, what you can see here, if you go under Research Center, under Resources, under Reasonable Basis, and click into there, what you'll see is all of our resources that we provide you to help you speak to your clients about our funds. So starting off with things like the reasonable basis summary, and all these are click-through live links. And without technical issue, it should launch. These summaries, as you can see on the slide here, what they show is that we talk about 2 themes that's currently impacting our portfolio, and then also how we actually access it. So it's a really simple way for you to talk to your clients about the strategies that we're implementing to derive the returns that we've been getting all these years. So that's the reasonable basis summary. Then on top of that, we come up with the top 10. And the top 10, effectively, just like a lot of other global managers do, they come up with the top 10 holdings of the fund, effectively 2 lines on what they do, and the 3rd line is why we buy it. You give this to your client, and what we found is what is most important is actually not the left-hand side of the page, but actually, sorry, not the right-hand side of the page, but actually the left-hand side of the page, because the left-hand side of the page is the logos, and that is what people need to get familiar with. You're talking about massive companies worth billions of US dollars, and people have never actually seen the logo or understand even what they do. Whereas you put Apple or Yum Brands or those sorts of companies on the screen, you'll see it really clearly and understand exactly where that is coming from. The final thing is our SOA templates. So continue to provide these for you, and whichever research house that you use, you just copy and paste, and here's the standard fund descriptions as to which fund to use and why you're using it for your clients. And these are the same ones that we use ourselves. This is dynamically updated, and what we ask you to do is actually bookmark this page, as you can see, premiumchinafunds.com.au/reasonable basis, and it's just a great way for you to keep updated and provide all the details as you need to your clients. Now I'm just going to open up here. That's all I wanted to say. Does anyone have any questions? I'm just looking here into the questions box. Someone's asked if we can get a copy of the slides in the presentation. Yes, we can provide you with a copy of the slides, so we'll make sure that that gets sent out. Does anyone have any other questions, yearning questions? Property markets, debt issues, anything? Happy to answer it. Just put it in the questions box, and more than happy to answer the question. We have a question that just came up. Can we give the slides to our clients? Sure. We'll send it out to you probably in PDF from a compliance perspective, and then you can just drag and drop what you want and just paint. Cut and paste what you like out of Paint for the presentation. Any other questions? We have another question that's come up. Shadow banks, is this working out? Yes, my answer still remains the same in terms of the shadow banking side. The government will allow more shadow banking products to collapse. These are banking products in the system. So if we allow them to collapse, then the population and investors will realize that it's no longer a really viable investable product, and it's not really a capital guarantee product like they think is just a high yield mezzanine debt. So watch for a couple of those things to collapse. But the positive out of that is that it doesn't impact the banks because it's not on the bank's balance sheet. And then the other thing to note is that the investor is the one that ultimately loses out. And so as these collapses occur, my perspective is that the money still has to go and then looking for other investment potential. And so this is where people start viewing the equities market to be a stronger way for them to get a return. Because remember that the mainland share market is an interesting one because 97% of the market is local money. Only 3% of it is foreign money. So when you see the big jumps and dips in terms of the equity market, it's because of locals. It's actually not because of foreigners moving in and out, where people traditionally have felt it is a hot market. Now, Hong Kong is a different situation, but China is very different in that way. We have another question. How much was decline in resi property over the last 1 to 2 years approximately? The last 12 months by square meter, it's dropped 4 to 6%. This is right across the board. 2 years ago, it was still very strong, so there wasn't a really decline in the resi property market. The biggest challenge for the resi property market at the moment is developers are struggling to sell any property that is larger than 140 square meters. This is clearly the statistics that we're coming out of Wind, which is a Chinese property statistical database. And so because of the attack on corruption by the new government since March last year, what we've seen on the back of that is that first-home buyers are obviously not interested in 140 square meters plus. They simply can't afford it. And corrupt officials are no longer buying into the market. So this is the portion of the market where the developers have been discounting very hard, actually in some cases 20 to 30% to clear the stock. But overall, anything under that is clearing like hotcakes very strongly, so we're not very concerned about that. Another question's come through. Growth rate to go under 7% in 2015 financial year, relevant or not? I don't see it to be too relevant in terms of from an investment perspective. A lot of things that we're investing in the China Fund at the moment is structural based. Effectively, the Shanghai Hong Kong Stock Connect and the offsets and the other further structural reforms, including Shenzhen Hong Kong, as well as China entering the MSCI China index. MSCI Emerging Markets Index over time. So we don't find it to be relevant. I'd expect that in maybe 3 to 4 years' time, you'll start to see even 5% growth come out of China. But how that impacts our investment strategy, it doesn't. Again, I go reflect back to US growth figures or Australian growth figures. None of us as advisors actually go out and invest based on solely on growth figures, and neither do we, because we're active stock pickers. Next question, can you see the FTA having an overall positive effect on the market? I don't think the free trade agreement will have too big effect on the market. The question from the advisor, do you want to clarify that as Australia or China? In China, I don't think it's got any blip of any impact of the way that we're investing. That's basically the thing. Next question, how do you see interest cut? Can the advisor clarify the question? I think you may have wanted to write more. Again, with the interest rate cut is solely a broad-based stimulus measure because they do see that the economy is slowing. The government does want to protect the growth rate at 7%, especially for this year as well as next year. So we just feel that they will continue to hold that line. We may see more interest rate cuts further, but if you look at the benchmark rates are very high against the rest of the world. And one of the things that I would say that the Chinese government does have as a ammunition in their toolbox is based on the fact that they have a contained inflation. If you look at other countries like India, where they're still trying to churn out strong growth, but net growth, net of inflation, China's inflation has now dropped to between 2 to 3%, which is a targeted range of most developed economies. And your growth rate is still far higher than that, so you're still getting real growth rate of anywhere up to about 3 to 4%. So if the government does need to cut interest rates further to stimulate the economy, I don't see that as a bad thing. We've seen that happen right across the Western world. Economically and economic perspective-wise, I think it's a good thing. But does that answer your question? I don't know if you wanted to express more on the question. But yeah. Does anyone else have any questions? They're all really relevant questions. Thank you for it. Thank you to the advisor that said Merry Christmas. So let's end it on that note. As I said, wish you a Merry Christmas, everybody. We're going to come out with more webinars very frequently next year, and the system seems to be working quite well. So I thank you for your attention. As I said, there's going to be a feedback straight after when you close the session. So if you're going to answer those questions, because we want to know what you want to hear about, we'd love to hear that. For those of you that have received our calendars and loyal clients of ours, we thank you for your continued support on that. So you'll receive those in the next couple of weeks. And by any means, if you want to contact us, contact your state manager if you're Queensland, or New South Wales and ACT, please contact Derek Paz. All the other states, feel free to contact myself, but obviously our advisor services number is Sydney 02 9211 3888. So good afternoon, everyone, and wish you a great end to your week. Thank you.